Welcome back, Nacho's Crypto Signals. Today, I want to talk to you about investment risk hierarchy. In the first video, we talked about risk adjusted returns and making outsized gains on your investment. But I want to dive deeper into that because there's many different things that you can buy, many different types of investments, and risks and rewards associated with those investments, right? So we'll start at the safest investment that you could possibly make. And different people might put these in a different risk order, right? But one of the safest things that you can invest your money in is a CD, a certificate of deposit. Now, your bank can pay up to 4 or 5% on your money, which doesn't even have to leave your bank, and you're making 4 or 5%. Now, if inflation is high, you might actually be losing purchasing power on that. Um, but it's an extremely safe way to make some kind of return, having your money in a safe place where it's not going to go to zero like some kind of shitcoin, or other riskier investments. Um, so I would say if you have just money sitting in the bank, that might be a good option because it's just going to sit in the bank anyway in a certificate of deposit. It's also safe because banks are federally insured, at least American banks are. I imagine European banks are as well. So up to $250,000 is insured just automatically. If the bank goes bankrupt, if anything bad happens, your money up to $250,000 is safe. The government will pay you back for that. Um, Next would be treasury bills. Arguably, this might be safer than certificate of deposits. Treasury is an instrument from the U.S. Treasury. You can buy these worldwide. Governments buy these. International companies buy these, and they're up to a year. So you can buy them for a couple of months, a half a year, but the return on these is quite low. Uh, but they're very safe. Essentially, the United States government would have to go bankrupt for you to lose your money. So, extremely safe. Um, Moving on, bonds. Another alternative that you might look at. You don't make a lot of money in bonds, 2%, 5%. Essentially, you buy a bond possibly at a discount. So, a bond has a principal or a face value, and somebody might sell you a bond. And people who sell bonds are governments. You can buy governments from the U.S. Treasury. The difference is a bond pays interest, and then when it hits the maturity date, right, the length of the period, which is a longer period than a T-bill, it could be 10 years, 20 years, 30 years. You get that face value back. You get the principal back. So if I have $100 bond and I need to borrow money, right? I'm a corporation. Local governments sell bonds. Tons of entities sell bonds. I might sell you a bond that is worth $100 in 10 years for $90 now. And so through the life of that bond, through those 10 years, you'll make a percent return every so often. And then at the end, you get the $100 even though you only paid 90. You can also sell bonds before the maturity date. And the value of these might go up and down depending on many market factors. Um, Essentially, you should think about how easy it is for people to borrow money. If it's extremely easy for a business to go to a bank and borrow money, they might not offer the best bond terms, right? Because they can just go to a bank, borrow a lump sum. But if money is more difficult, like right now, interest rates are up, liquidity is dried up, maybe banks aren't lending, this is an option for a company to go to the market and sell bonds as an investment instrument for people to buy and as a way to raise money for the company. And so essentially you're making the interest lending the money to this company that a bank would make. Um, you don't make a lot of money with these. They can get a little more complicated, and essentially, only like governments, large companies buy these. Maybe old people buy them. I wouldn't suggest buying bonds really. Um, Next up, a little more risky, still not that risky, would be what I would call safe stocks. So I'm putting utilities, cyclicals, and blue chip companies in here. Utilities are like your power company, your water company, right? People are always going to need electricity. People are always going to need water. So betting on these companies does not give you a high rate of return, right? They're pretty boring, pretty safe, um, but you can grow your money investing in these, and it's not like you're going to lose a ton of money. Next up, more risky would be some more volatile stocks. So I put in here like tech stocks, startups. Now here you can actually make some more decent returns. Um, you could double your money, you can triple your money. Think about investing in Google, right? Like, no, yeah, I mean Google as a startup or Google Now, Apple. These companies grow, and it's not like they're going to go to zero, right? Like some shitcoin might. Um, Next up, I put forex trading. So yeah, people might argue that this might be more or less risky than some stock trading, right? Um, but forex is foreign exchange trading. So essentially, you're trading currencies. You're betting on currency pairs like U.S. dollar, Japanese yen. You're saying that one is going to be lower in the future or higher. No. Um, um, so if you think the yen is at a discount now, right, and it's going to be worth more in the future, you might take your dollars, buy yen today, hold it until it's worth more, and then sell it at that point back for U.S. dollars or maybe for some other currency. Now, I think this is riskier than stock trading because governments devalue their own currencies all the time. I mean, we in America we hear about China devaluing their currency. I mean, America is no angel either. So you might get into this, and a complete unforeseen event happens, and then you're on the losing end of a trade. And it's not like the Central Communist Party of China is going to call you up and say, "Hey, like we're going to devalue our currency." They just do it, and anything could happen. I've personally lost quite a bit in the forex trading. I'm not a huge fan of it. Um, but if you're privy to some information, if you're wise to the movement of different currencies in relationship to each other, that could be a good option. Um, More risky than that, and also more possible rewards, I would say, are penny stocks. So penny stocks are stocks that are worth less than a dollar. And these are normally unheard of, incredibly small companies that you can buy a lot of stock in, right? Because their stocks are worth so little. And if they go up to be worth a dollar or multiple dollars, you could make a lot of money on them. However, there's a lot of scams, there's a lot of fraud, there's a lot of risk there. So, a lot of risk, a lot of potential reward. Next, I would put derivatives. This can be a little more complicated to think about, but simply, a derivative is when you bet on an underlying asset. So you could do this on stocks, you could do this on commodities, you could do this on all kinds of stuff. So one simple example would be, you and me are going to enter into a contract, right? I think that the price of this stock is going to go up, and you think that the price is going to go down. So me and you make a contract together without ever actually even touching that stock. And that's hence the name derivative. We're making a derivative thing, a separate contract, and we never buy that stock, but we're betting with each other about where the price is going. Um, Derivatives can include the most popular ones are futures and options. Futures, you're betting on the future price of something. Um, a popular one is commodities. So I think the price of copper is going to be X more dollars than it is today, and we enter into a contract. Options are a little bit more complicated than that. Options are a way for people to, with a smaller amount of money, bet as if they had a larger amount of money. So if I only have $1,000, right, instead of going and purchasing Apple stock, right, and then I hold the stock, I can grab that $1,000 and enter into an options contract and buy the option to buy or sell 10 times or more or less, but way more than if I had just taken that $1,000 and bought the stock. There's a lot of risk involved because depending on the price movement, if the trade goes against you, you could get margin called. You have to have a certain amount of money or value kept for this contract to keep going. If your money does not cover the contract because the trade is going against you, you can get liquidated. You can lose all of that money or part of it. So it's more dangerous than just buying the stock because if you buy the stock, at least you still have the Apple stock. Maybe it went down, maybe you have less money. But if you buy the option, you could lose all of your money just because the trade went against you. But if the trade goes for you, instead of making $1 on each stock that you bought because you purchased more stock than you could have, maybe you're making $5 for every dollar that that stock goes up. Maybe you're making $10 for every dollar that that stock goes up. It's a way to multiply your exposure to that trade. It goes quite deep. It's almost like a science. You have to learn like a quarter of the Greek alphabet and all of these mathematical notions of how it moves. Um, but if you want to get into options, there is good money to be made there. I would say up on the risk hierarchy here would be shitcoins. Or actually, we skipped over blue chip cryptos. Um, so less risky, right, than shitcoins would be blue chip cryptos. Blue chip just means it's of the highest quality. So your blue chip cryptos are Bitcoin and Ethereum. That's it. Bitcoin's been around for I think 10 or more years at this point. It hasn't been hacked, um, and it's seen as digital gold. It's known worldwide. Everybody knows what Bitcoin is, but nobody, not a lot of people know what DOT is or some other smaller coin. So it's a lot less risky to buy Bitcoin, but also they're not going to make as much return, right? Because Bitcoin's already worth so much. And we talked about this in the first video that if you want to double your money on Bitcoin, something like $500 billion needs to be invested into Bitcoin. Ethereum is another blue chip crypto. Uh, it's known worldwide. It's trusted. A lot of people love Ethereum. So that would be a safer alternative than buying a smaller coin, or as many people like to call them, shit coins. And next up on the risk hierarchy is shit coins. So these are cryptocurrencies. Maybe they just came out. Um, or maybe they've been around for a long time, but they have a smaller market cap. Smaller than Bitcoin, smaller than Ethereum. They're less known. And These are quite risky, quite risky. A lot of times these coins are just straight up frauds. A lot of times the founders of these coins, they just run away with people's money and you could lose everything. A lot of times people just lose interest in these coins over cycles. Maybe it was popular in the 2017 cycle, but this cycle, there's a brand new shiny shitcoin over here, and nobody wants the old one from last cycle. So everybody forgot about it. The price tanked, and it's worth nothing. But this is also where I think, and many other people think, that you can make the most amount of return in the cryptocurrency market in the smartest way. You could also um, leverage trade. Not recommended. But essentially, you buy into a tiny small coin. Let's say it's worth $50 million. Then, if it goes to $500 million, you just 10x your money. That's 1,000% return. Technically, 1,100% return. It could go to $5 billion. It could go to more. Right? Bitcoin's worth 500 billion, and we're in a bear market. Right? In the bull market, arguably, it will reach much more than that. I'd like to use that as a kind of like a top, like your shitcoin. It's not going to surpass the value of Bitcoin. So max amount that it could get to would be a fraction of what Bitcoin is worth. Right? Bitcoin's the king. It's worth the most. It's number one. It's never been unseated as number one. No other coin has ever reached the value of Bitcoin or more. So you could say that is the limit. It won't reach the price of Bitcoin. It probably won't reach a quarter, a tenth of it. I think Ethereum is essentially worth about a tenth or just a little less um, than Bitcoin by market cap. So this is where you can get your 50x returns, your 100x returns, and this is where this channel is concentrated in. So I'm not going to talk about stocks, really. I'm definitely not going to talk about bonds or T-bills or any of that. I'm just trying to let you know that if you want to diversify your portfolio, if you want to put some of your money into safer um, investments, you can do that. You can, put in 50% in some safer stocks, 25% in some riskier stocks, and then take 15% into your blue chip cryptos, right? So Bitcoin and Ethereum, get some exposure there, and then the smaller amount into some more volatile, more risky small cap coins. I personally like to go all in on the smaller cap coins, on the shit coins. That's where most of the returns are made. That's where I've had the best experience, the best returns, and so that's where I tend to go. Maybe a little bit of Bitcoin, a little bit of Ethereum, maybe 10, 20% of my portfolio, and then 90 or 80% of my portfolio on shit coins. Yeah. And there's more risky things that you can do. You can leverage trade. This means that you borrow money from the broker or your exchange to trade with more than what you actually have. So if you have $1,000, you can leverage that up to $2,000, $5,000, $10,000 and trade as if you had that much money. But you run the risk of getting liquidated again. You have to have a certain amount of money to keep that trade going. And if you fall below that, the more that you're leveraged up, the tighter the rope around your neck, the closer you are just naturally to being liquidated. So it can be extremely risky, and you can lose all of your money. And you can leverage stock trading, or even more risky than that, you can leverage shitcoin trading. Definitely not advisable. So there's your basic hierarchy of risk for investments. Now, there's one more thing I want to talk about, and it's how you personally might want to think about risk. Um, I would say first you have to think about your personal situation. If you invest in the market, are you investing money that you should be feeding your baby with? Are you investing money that you cannot afford to lose? Or are you investing money that maybe that you were saving for a vacation, right? Like if you lose this money, is your child gonna go hungry? Or simply, if you lose this money, maybe you can't afford a nice toy that you were saving up for, or a vacation, or something like this. Um, so you have to think about your life situation. You have to think about the general rule of thumb, especially in crypto, is you only risk, you only invest the money that you can afford to lose 100%. Money that can go to zero and it won't affect your life and you'll still be okay. So that's a good rule of thumb to follow. Um, and I would highly advise that. Another factor that plays into your personal risk tolerance is age. If you're younger, you have your whole life ahead of you. You can have many jobs. Whatever money you lose at a young age, you can make back later on. If you're later on in life, or if you're old and retired, you essentially have a nest egg. You have a certain amount of money. You're not really making more money back. And so you have to be very protective of it. And you want to take less risk, right? And one last thought that I want to leave you with here, right? And it's that a lot of people take losing money very hard. And I'm not saying that it's easy, but I, I personally think about it as an investment into education. So if you go to take a class, if you go to university, that's not free. You pay somebody, right? And they teach you how to do something. So in crypto, in investing, you will lose money. Definitely. That's almost assured. You, well, especially in crypto, at some point, probably sooner than later, you will lose money, right? So think about it as the market is teaching you some lessons. Every time that you lose money or that you make a move or that you get into a position and you observe how the market moves, you're learning. You're investing into your own education. And so even if you lose some money, right, you could think of it as an investment into your own education. I hope that helps. Thanks for watching.